right, so welcome to Game Plan Sunday. Today is January 9, 2022. Happy New Year's, everybody. We made it. You're here, so congratulations. Had a pretty interesting year. Overall, it was, pretty good for the markets and everything. Coming into this year, we're already starting off on a bad note. As we ended the last week here, everything pretty much was down. And we had lots of economic data last week that we'll cover here. We had some ISM numbers. We had the Fed's numbers. We had the employment situation numbers that were reported as well. And all of that was, pretty much adding to the volatility that we've seen in the markets for the, beginning of the year. So what we'll do is just jump into the review from last week at the sectors and the indexes. And so what we had here was the oil. Oil rocked it out last week, 4.63%. There were some really good plays in the chat room. Came from good old Ron B. Came in with those oil plays. So if you was in there, you'd have been eating off those moves in oil. The dollar also rose as well, and we got that at 0.07%. The Dow Jones was down slightly. The gold was down slightly as well. S&P 500 was down slightly. The Russell was down negative 2.92%. The NASDAQ was down negative 4.53%. And Bitcoin took a beating at negative 9.72% over the week. The sectors, what was leading the way was energy. So energy was doing real good, 10.52%. Man, that was a spectacular week. You already see the charts. It's like, financials were also doing good, did a half of that, 5.43%. And industrials was up 0.64%. Consumer staples was up slightly at 0.40%. Everything else was down, as you see, materials, communications, utilities, consumer discretionary, technology, healthcare, and real estate was all down here in the red. So that was pretty much what last week looked like. Kicking off the week, though, we did have, let's actually just jump into let's see what we got here. We're going to jump over into the JOLT numbers. Okay, to start the week off, we had the JOLT numbers. JOLT is the job openings and labor turnover for the month of November. And so anyhow, as we have all these economic indicators, these reports that release every week in the markets, anything that's market sensitive, our website here at Wallstreet Jackboyz, it has it built into the calendar right here on the left side. You guys can see it right over here. Every day you come into your news feed, you'll see what's coming down the pipeline every week, every day. All right. So it'll take a lot of work to put that together for you guys. And I'll show you guys some of that as well. Like when you actually go into these, click on these events, you can actually click on them and get to the links, and we get the source directly from the source. So therefore, you're not having to worry about, the financial, magazines and stuff like that, newspaper articles coloring the information. You can actually see what the same data that they're reading and they're putting their color on it. You can actually read it for yourself. And I try to cover it for you guys as well in the Game Plan Sundays, but you can check it out right here in the news feed. So definitely take advantage of that. All right, so the JOLT numbers here. This is basically where we get to see the turnovers, the quits and stuff like that. And so taking a look at this, we can see that there was a record high of 4.5 million quits. Okay. The decline in job openings came as the number of people quitting their job rose to a record high of 4.5 million. Let me just click on this real quick. All right. So here it says in November, the number of total separations increased to 6.3 million. Okay. The total separations rate was little changed at 4.2%. Total separations increased in accommodation and food services. So lots of food service jobs where people were separated. Decrease in federal government, and total separation were little change in all four regions. Okay. Now, this is what was interesting. The number of quits increased in November to a series high, 4.5 million. The quits rates increased to 3%, matching a series high in September. Quits increased in several industries, with the largest increases in accommodations and food services. Food services, there you go. Healthcare, social assistance, transportation, warehousing, and utilities. All right. And he said the number of quits increased in the Northeast region, South, and the Midwest regions. So that's where a lot of those quits were. So this was big news here. again, that's a lot of people quitting their jobs, and what all the economists are trying to figure out are why, and if they are quitting, then what are they doing? Where are they going? Right? You need, in a society, you're going to need people to be productive. Productivity is vital for any society. And so when you have situations like what we're dealing with right now, where there's not enough people that's in the labor force that's working and they're quitting, you have societal issues. Okay, so just keep that in mind. This is right here. This is not good with people quitting like this. And so there's several reasons that we could speculate on why people are quitting. You know, it could be the stimulus stuff. It could be, you know, just people think they can get a better job or what have you. But what's interesting is that from the employment numbers, we're seeing that the economy is, as far as employment goes, is maxed out. So we'll cover some of this here because we did get the Fed's meeting, the Fed's minutes that were released, and this is where mayhem hit the markets last week. As soon as the Feds, you know, released the minutes meeting here, which is on the website as well. Just click it and we'll go over it. But we'll cover some of those things here that they are talking about that they were seeing. Now, when they have the meetings, they don't release the paperwork until a month afterwards. So this is, you know, this is what occurred in the meeting from December 14 and 15. We're just not getting the report now, and then the markets are, relating to it. So when you get the report, this is what spooked the markets, had the market shook, right? So I'll go some of the highlighted points here. It says the committee would quicken the pace of reduction in the Federal Reserve's net purchases of Treasury securities and agency mortgage-backed securities. And the median respondent projected net asset purchases to end in March 2022. So they're talking about ending all of that in 2022, March. That's like 2 months from now. That's really, really fast. But before, they was talking about June. The median respondent projecting timing for the first increase in the target range for the federal funds rate also moved earlier from the first quarter of 2023 to June 2022. So they were talking about not raising rates until 2023. Now they're talking about raising those rates sooner. Here it says June 2022, but I think they're actually talking about doing it even sooner. They're talking about doing it at the same time, which should be around March. And so with that type of information coming through the markets know that's the punch bowl getting taken away. The Feds is no longer going to support this thing. You're going to see the stock market fall or crash or what have you, more than likely. So you're going to a higher, increased volatility situation here, where a lot of dumb money, a lot of this, free money in the market has been holding up the markets. With the Feds, removing that, it's going to fall. So here they said inflation readings remain high, and various indicators suggest that inflationary pressures has broadened in recent months. Remember a year ago, they were saying it was transitory. That was odds. Don't worry about it. It's going to go away. It's going to just come up. We got this 2.5% target. We just want to get it up a little bit above 2%, 2.5%, and then it's going to come back down so that it end up averaging out at 2%. And here we are, CPI at 6.8%. We get the CPI numbers this week. It's probably going to be at 7% actually. So these numbers are far above and beyond what the Feds were actually trying to do. Remember, they wanted to create inflation, and this is what they got. But this is what people was talking about. You got to be careful when you let, the inflation genie out of the bottle, because it's going to be hard for you to put it back in. He ain't going to want to go back in. So that's going to be very problematic. And then the PCE numbers here, it says that the real PCE growth appeared to be picking up in the fourth quarter, despite an upturn in COVID, or I should say the Rona cases, the waning effects of previous fiscal stimulus measures, lingering supply bottlenecks, and recent increases in consumer prices. In particular, real expenditures on retail goods rose solidly again in October, and outlays for services strengthened. All right. So again, these are two different inflation metrics that they use, the CPI, and they love the PCE. And they're telling you that inflation is problematic. Again, this report is very long, so I'm just going to skip through some of this stuff here so we can get the main juice. It says that market participants views on the expected path for the federal funds rate, as implied by straight read of overnight index swap quotes, suggest that they had pulled forward expected rates increases more into 2022 and 2023 compared with the timing they anticipated at the time of the previous FOMC meeting. So again, all of this has definitely drastically changed since the last meeting. Now they're pushing it all forward, meaning we're going to get this quicker than expected. The potential for a less accommodative policy stance over the next few years contributed to a notable rise in 2- and 5-year Treasury yields. All right, so that's the writing on the wall for the markets. Now, the question is, can the Feds do this thing that they're talking about? Man, we are here yet to find out, but this is what, it's got pressure all over the markets here. Let's see. Next valid point that I can pull from here. It says that participants pointed to a number of signs that the U.S. labor market was very tight, including near record rates of quits and job vacancies. We just talked about the joke numbers. We got these record quits, which is crazy. And you know that the Fed's mandate is maximum employment and this 2% inflation target. And so if we're already at maximum employment, again, we're looking at a situation that we described before from like the Great Depression era, where nothing that the Feds can do can save the economy. Then you go into depression, a Great Depression. All right. In line with the recent data showing a rise in the employment cost index. Actually, I forgot. I didn't skip this part here. It says, as well as a notable pickup in wage growth. So you're getting these wage growth, this wage increases. But again, these are some of the same arguments that we have about the Feds raising the federal minimum wage requirement. But instead of the government doing it, all of this confusion in the markets is causing the increases. And some of the same arguments about when you raise those minimum wages, although it's not federal, right now it's a competition thing that they have to, they're forced. But at the same notion, you'll have people unemployed at a lower wage. Okay, so at a higher wage. So a higher wage, higher minimum wage, but also a higher unemployment. So do you want to be unemployed at a higher minimum wage? No. You want to be able to get a job, whatever is available, But so all of this is market confusion that is really just not good for the markets. Participants generally noted that they are monitoring the incoming data for signs of inflationary pressures associated with the increasingly tight labor market, acknowledging that the maximum level of employment consistent with price stability may evolve over time. Many participants saw the U.S. economy making rapid progress toward the committee's maximum employment goal. Several participants viewed labor market conditions as already largely consistent with maximum employment. So I was telling you guys earlier is that, we already at maximum employment. It's tapped out, right? Can't get no more jobs. And we're also seeing that those job numbers, the hires actually slowed down. And that was in the JOLTS reports as well, but it slowed down for the past few months. And so, again, they're talking about the economy so strong, but really it's not. You got all these quits. There's just chaos right now. And they talk about price stability. There is no price stability with the Fed's intervention here. This is just chaos in the markets. The markets got to figure these things out. And so all this intervention stuff is like really distorting the markets. And so you have a real volatile market. They're going to have some big winners and you're going to have some big losers here. And so as traders, are you trying to, capitalize on those opportunities? All right. Let's see. Over the course of 2022, as supply constraints ease, almost all stated that they had revised up their forecast of inflation for 2022 notably, and many did so for 2023 as well. So they're expecting inflation to be here 2022, 2023. What happened to the transitory narrative? Okay. Somebody got to ask the question. Participants pointed to rising housing costs and rents. Those are not coming down. They don't lower rents. They don't lower none of this stuff, right? And they got these crazy reports was talking about here where I'm at in Charlotte is like the cheapest place to live or something crazy. I was like, what? That's not true. Ask the people that live here. You're paying $2,600 for a 2-bedroom. That's expensive. More widespread wage growth driven by labor shortages. So again, you got the labor shortage problems, more prolonged global supply side frictions, so supply chain issues, which could be exacerbated by the emergence of the O variant. So that's the Rona. And again, something got to get the blame. They want this, this virus situation to keep going so they can blame all this stuff on the virus. Moreover, participants widely cited business contacts feeling confident that they will be able to pass on higher costs of labor and material to customers. So again, they've been able to see last year, we didn't feel the price increases. We didn't feel the inflation. But this year, we're going to feel the price pressures. They're telling you right here that these guys, they've been able to, suppress it. Now they're going to release it. And so Inflation is, again, and when you're looking at this inflation stuff, I mean, you're talking about looking into the future, like what's going to be coming. Like, so this is going to be here, so you're going to be in a very inflationary environment. That's basically what it is. All right. What else we got here? Okay, so the increase in policy accommodation provided by the ongoing pace of net asset purchases was no longer necessary. They remarked that a quicker conclusion of net asset purchases will better position the committee to set policy to address the full range of plausible economic outcomes. So they say they no longer need to be buying these treasury securities and mortgage-backed securities. They need to go ahead and end that. Participants judged that it would be appropriate to double the pace of the ongoing reduction in net asset purchases. Such a change will result in reducing the monthly pace of net purchases of treasury securities by $20 billion and of agency mortgage-backed securities by $10 billion starting in January. So that's this month, January, $30 billion they're going to be removing. Participants also expected the economic conditions would evolve in a manner such that similar reductions in the pace of net asset purchases would be appropriate each subsequent month, resulting in an end-to-end net asset purchase in mid-March. So they're looking to clear the sheet, clear all the spending by March, a few months sooner than participants had anticipated at the November FOMC meeting. In addition, participants remarked that the committee should continue to be prepared to adjust the pace of purchases if warranted by changes in the economic outlook. Again, this is talking about basically what they're saying. They need to be in a position where they can get this thing down, but also just in case things turn negative, they need to go back and ramp this back up. They're going to go back buying again. So, I mean, that's pretty much it, man. Again, you guys can check out the full report, but I think you get the gist of it. Everything that we've been saying, they're having to capitulate on because inflation is not transitory. So, and it's going to be here. So just keep that in mind. That's why the markets was spewing up, vomiting last week. And we'll see if we'll get more continuation from that this week. If you guys remember back in 2019, the last time when they went to raise rates under Trump, how the markets, spit up, vomited and sold off crazy. And then, Powell, stopped and put a pause on raising interest rates. And it was like, we're going to play it by ear. And then it just so happened to be, with the Rona situation pop off, they end up just cutting them and everything. Which again, the Rona gets the blame. I guess you need something to blame, right? So anyhow, that's what we have on that. And excuse me, let's get to the next report here. We did have, let's see, we had the services PMI number that I was just looking at here. But then we also had, I don't know if I posted it or not. Did we get the, maybe we didn't. Here we go. Yeah, we got the PMI, the manufacturing PMI numbers here. So the manufacturing PMI numbers came in at 61.1%. Let's just take a look at the sheet real quick. All right, so the manufacturing PMI numbers, as we see here, international component shortages continue to cause delays. All right, petrochemical supply chain is slowly slowing signs of improvement after multiple weather. So they're improving. Large volume drops due to chip shortages. So again, supply chain issues. Capital spending remains flat for now. All input costs are going up considerably across the board. So if these guys' input costs are going up, they're going to have to, push that on to customers. So at the end of the day, you're going to feel that. Let's see. Fabricated metals, while steel, plate, and hot rolled coil pricing seems to be approaching a plateau. The biggest challenge we have at the moment is finding qualified workers. So they're saying, okay, price is starting to plateau, but they're not finding the workers, man. All right. And let's see what else we got. We're still seeing shortages with various metals. So shortage of metals, electronic components, lead times are still moving out. All right, so still, supply chain issues here. Business is strong, but meeting customer demand is difficult due to a shortage of raw material and labor. So on one hand, you got a shortage of real goods, real materials, raw materials. Then on the other hand, you got a shortage of labor. People need to be productive. You don't have a productive society, it is going to crumble. All right. In the first 9 months of the year, business conditions were off the charts and sales by far outpaced capacity. This has put backlog at record levels. And surprisingly, customers have been willing to wait, albeit reluctantly. However, there seems to be a flattening. Sales remain strong, but are not growing at the same month-over-month pace from the previous 6 to 9 months. Again, you're getting a slowdown over in the machinery area. And then here they says, we are experiencing significantly supply chain disruptions, which are resulting in historically long lead times. Commodity-based inflationary pressures are widespread. All right, so I'll just end that there. Basically, again, more inflation coming down the pipeline. This is problematic. Labor shortages, raw material shortages, it's all there. You guys see it. And then the backlogs are mounting up. So that's telling you that demand is strong. People want, but don't nobody want to put out the work. And you have an issue. All right. And I know we had those crazy zealous ADP numbers that was just, skewed terribly. So we don't even have to cover that. All right. Now that we've got that out the way, let's take a look at the servicing side. Jeez Louise. That was really long. That was that Fed article right there. All right. And so here go the ISM service numbers that came out at 62%, which again, above 50 is growing. Let's see what they said. Pretty much the same stuff, right? Supply chain issues. Supply chain challenges to procure supplies for our restaurants remain our greatest obstacle at present. Along with staffing needs, we're considering another price increase after just one in 2021 in August. This is a combination of food services. Told you, they're gonna have to pass the cost on to us. We didn't feel it. You guys did not feel the pain last year. Won't feel it this year though. Supply chain issues continue, but our business is adapting. Supply chain issues. The escalation in costs for material, fuel, labor, lodging, and the like continues to negatively impact margins in an unsustainable direction. This is construction. They're having issues, okay, with all kind of cost issues, all right? And it said it's negative impact in their margins. No good, no bueno. Higher than normal employee attrition within our own company and at our suppliers, which is causing disruptions and delays. People ain't working, B. I don't know what you need to see. How much more do you need to see here? There's widespread fatigue across the organization as the Rona hospitalizations have plateaued. But in the face of yet another variant, the O variant, the winter forecast is not positive. They're negative. They're pessimistic, you can see. Although hospitalizations have eased, demand for services is up, as is acuity of patients. Due to mainly logistical concerns, the supply chain remains turbulent, and some supply shortages, including of vacuum containers, are hindering operations. Our organization is cautiously optimistic going into flu season. So you're going into flu season, you got this whole old variant situation. And like I said, this is healthcare and social assistance. I mean, everything is getting clogged up. For one, you don't have enough people working. So again, it just doesn't make sense for them to even have these mandates, for one, in a time when you need people to be working. I mean, it just really pushes people away from the workforce. And so again, these failed policies, these central planners, whatever agendas they have, they're just not working. And it's going to be at the detriment of us all. And we clearly see that's what it is. All right. Activity continuing to maintain a steady pace. Inventory levels and outages are persistent with our suppliers. I mean, these are persistent. You can't get nothing. Can't get no satisfaction. However, starting to see some relief in the supply chain, but not below the critical point yet. Prices continue to be driven up, prices going up, with shipping costs the largest driver due to inflated pressures on capacity and fuel costs. Fuel going up. They'll go Ron B with those. He was telling y'all about them calls in XOM, right? XOM. Electronic chips shortages severely affecting deliveries from our supply base, thus impacting our ability to deliver to customers. Long lead times, transportation bottlenecks, delivery inconsistency, price increases continue to affect a range of products. We continue to experience supply chain disruptions across the nation and across the globe, resulting in raw material and subcomponent shortages, longer manufacturing lead times, transportation and resource constraints, labor pool issues, and significant price increases. All right. He didn't say just regular price increase. He said significantly. Supply management continues to recommend pulling in demand. They want to pull in demand, placing orders earlier than historical lead times for long lead time materials, and qualifying secondary source of supply. Demand is good, but supply chain issues continue to get worse. Trucking availability is worsening, not getting better, it's getting worse. Labor shortages are causing issues. We could do much more business if we had more people and access to more products. Again, same thing I've been telling you guys. This is a recipe for disaster. He's talking about, a whole entire civilization crumbling. You're looking at the Roman Empire 2.0 here. All right. And then we got the employment situation numbers. Let's go to that here. And then Terry, he blesses with this one here. What's cool is that they tell you what the expectations were on this article here. So it says hiring falters in December as payrolls rise only to 199,000. The problem with that was that they were expecting 422,000 jobs to be created, and that did not occur. Only 199,000, and the markets continue to sell off from all this negative information. And so, as you can see here, they said a total non-farm payment employment rose by 199,000 in December, and the unemployment rate declined to 3.9%. So the declination of the unemployment gives this false sense that the economy is strong, but again, it's not. Again, we're looking at 4.5 million people that's quitting their jobs. 6.3 million people that's separated. You can't have a productive society like this. But when they're looking at it like prior to the recession that was shortly ended with all the bazooka of cash that was put into the system, you can see that the numbers are back where we were before the pandemic, basically very close. So this is what we're talking about with the jobs being maxed out. Like there's no more growth in here. And even in the Fed's reports, they was looking at maximum employment. They're saying everything is looking consistent. They don't want to confirm it, but when you can look at it, it is there. And then the JOLTS numbers, we can see that hiring is slowing down actually, and this is just not good. At the same time, the Feds want to remove. They're going to be removing their support for the market is what they're saying. I don't actually think they can actually do it. We'll see if they actually do. I mean, maybe they'll try to get one off, but they continue. The market is going to puke, and then they're going to be forced to capitulate. All right, let's take a look here at the mortgage rates here. Mortgage rates leaped beyond 2021 peak over 3.45% for 30-year fixed. I said, is this a goodbye to historically low rates? Actually, you can see the last rate update was 3.5% on a 30-year fix. So those mortgage rates jumped. And just to show you, again, for those people out there looking to buy homes, I mean, you missed the bus, like Chris Cross said, I missed the bus. And so anyhow, at 3.5, this was back in, the beginning of the year. And so we have of last year, and we have surpassed that. So mortgage rates are going up. So you better lock in your rates soon because they're not coming back down. We are in a higher interest rate environment because inflation is out of this world. Fed's going to have to do something. I just don't think they're going to actually do it. I think that, again, they're giving themselves some space that maybe they get one off, but then they'll have to end up coming back to, dropping these things back down. At the end of the day, what's going to have to be sacrificed is going to be the dollar. They're going to have to sacrifice the dollar. It's going to be too much pain. You in an election year, with the politics at play and stuff like that. Listen, they are not going to go through with this. So right now, the market is going to move based off of that news, but we'll see. All right. So looking at all of that, let's take a look at the charts here real quick. And if you guys got any plays you want to take a look at, you can start dropping those in the queue. But just looking at the NASDAQ, this is what damage was done last week. You guys can see. All right, so we got those record highs back here. And then from there, we got tapped out right here at this level. It's still chopping around. This is on a weekly chart, by the way. But you can see this long candlestick that dropped. Like, that was pretty big. Okay, it did snap down to the floor. So we have to see, what it's going to do this week. But let me just train in and dial in back on a daily here. We can see that the trend is looking downward. We're on a daily, we're under the 100 moving average. Got a sell trigger rest right here. It is on the support line here. I hate to have all these lines on the screen for you guys, but again, this is old lines that I drew a while back, and they stay on here and they work. So you can see that floor right there, and that could be some type of triple bottom setup. Okay, like this, you don't have to go all the way short just yet, but again, that could spark that type of setup, or it could just come back down some more. Come down to this 200 level floor. All right, if not, then you'll get the type of triple bottom type setup. Could be. All right, the market is real volatile right now. So there's no telling. I wouldn't marry any ideas, not for long term. It's kind of crazy. Let's take a look at the S&P 500. All right, we can see the momentum signs are showing downward as our price is trading underneath the mean. as well. So again, this is not in good territory. However, they fared better. The S&P 500 fared better than the rest, trading right here at the 50 moving average. So although it's under the 8 moving average, it's still right above its 50. Has not broken that yet. And so if it holds here, then again, this will be good for, equities. If not, then look for the 100 moving average to be the next floor. All right, and then take a look at the Russell. All right, and then the Russell's also looking bearish as well. And we can see, how that's panning out. I think we were kind of speculating that this is going to be an inverse head and shoulders. So you guys can kind of see a little pattern like that. That looked like it could be an inverse head and shoulder. That would be an interesting play out if it does do that. But as of right now, I don't have any indication that that's going to play through. Got the sell trigger here. Price is traded underneath the mean here. So again, this is bearish. This could be, more of a bear flag type situation. Just don't know yet. But it does look bearish. But I wouldn't marry the idea totally because the market is real tricky right now. But so far, I'm just leading in with bearish sentiment here. All right, and let's take a look at let's see if I can get the VIX up. Yeah, and then the VIX is actually in a position where it's looking very interesting as well. So I had these levels here, and I called it out last week. When it came down to this floor, I was like, yep, it's actually strengthening up right here at the floor. As soon as it came down, hit the floor, and then it's bouncing up here. All right. And so the question is what is the VIX doing? I mean, listen, the trend is up. It's in a little squeeze here. It's in this over, sold territory. So that means that it can bounce more, has a potential to bounce more. It doesn't mean that it is. But looking at this little pole right here, we could be looking at a little flag popping off at the VIX. All right. So it could be some type of flag forming on here, which would be more pain for the markets, which we just got all the data and news that, could contribute to that idea. With the Fed's tightening or supposed to allegedly tightening or less accommodative, whatever you want to call it. I think that could be the catalyst for that situation. Let's take a look at the dollar. And so the dollar is in a very interesting situation because, again, we just talked earlier about them sacrificing the dollar, and all that the dollar price has gone up. Our purchasing power has not gone up. Inflation has been eating away. And so you see the price of the dollar going up. But is this sustainable? I think it's a lot of speculations on this whole situation. I saw a debate with Peter Schiff and Brent Johnson, a very interesting one. These guys, they constantly debate and they have their two sides. And I know, Brent has this milkshake dollar theory situation. But it's interesting when you actually approach it from like a technical point of view, as like a trader, when you see this chart on a dollar, I mean, it looks like it's got, potential to move higher. They're like a clear double bottom situation on the, weekly chart. Okay. Right up into this level of resistance. But overall, do you want to short this level? When you dial in on a daily, right, you get a more little defined pattern of what's happening here. As we scroll, let me actually put it up here. You can see that resistance that's in there. And you can see that this was like, boom, it got rejected clearly. And then, boom, this level here, rejected clearly. Look at that drop right there. So I think the key thing is, can the dollar hold this 50? If it can hold the 50, then we may see it go up more. However, the signs are pointing downward. I got a sell trigger that's in here. All right. Even the squeeze is starting the momentum is going downward. You can see a little scooping down. And so it looks like the dollar may get rejected here, which, I mean, it should. But again, you have, in irrational markets, they're looking for places to put money. They don't know where to go. There's no real price discovery. So you just get, crazy direction. But I wouldn't short it unless it drops beyond the 50 floor. That floor on that 50 is a strong support line. You can see it back here. You can see it back here. You see it back here. And now we're back there again. Question is, will it hold? All right. So that's that dollar for you. Also, let's take a look at Bitcoin. All right, we can see Bitcoin is having a tough time here. They have plummeted, back from this high all the way to this low. I mean, geez Louise, I don't know where the diamond hand players are, if they still exist, because they probably got pulverized from this. I mean, again, if you got in here, from that time, then yeah, you're definitely done. If you got in any time, I mean, geez Louise, Bitcoin is having a real tough time. And I mean, they did get all the way up to almost 70,000, which again, I know they was trying to, people was targeting, $100,000 Bitcoin last year. That never actually came about. And they have countless marketing, things that, you just see it all over. They're trying to push this thing, but clearly Bitcoin is having a real rough time. Here's the non-moving average. Is trading under all of its key moving averages, 200, 150, not everything. Prices going lower and lower. And so just taking a look at the 2618. It's right here. It's likely the next level on this one here that I think Bitcoin could go down to. So you have to see how that play, man, for all you crypto lovers out there. Hold on. That's what they tell them. Hold the door. They get murked right now. All right, cool. So I think we covered pretty much everything on this one here. Do you guys, any stocks that y'all want to look at right now? I know that we were talking about the energy sector. Let me just show you the chart on that. That had a real nice bang. That squeeze fired off long. Bingo, that squeeze was there. Green dot means it's fired long. So that was a choppy situation. Weak hands had to fold. Those who held strong, they stayed in and got the reward. That was good. Took a look at these ZOM calls. These are ones that Ron was throwing out there for you guys in the chat room. And that was a beautiful play. And it did hit the Fibonacci targets, okay? And that was a really beautiful setup there. So hats off to you for that. There's some other plays like, let's see, Lucid. This one here is pretty interesting to me. We'll see how it plays out. I wanted to get some exposure over the weekend because normally, well, not normally, but in this past season, we haven't seen the market sell off for consecutive days like we had this past week. And so normally when you get, all these consecutive days of sell-offs, you're going to get some type of breakout when people are basically dip buying. So those major sell-offs, you find these different points, and then, big boy investors, they're buying these dips, and then, you get a nice bounce out of it. So I want to get some exposure in here. Chart looks pretty interesting. We'll see how it plays out. So far looking pretty good, but it's got this 100 moving average floor right here. Had a buy trigger. Okay, so we saw price was high here. You don't want to buy high, you want to buy low. That's what the big boy investors, they're buying low. And we got a buy trigger in here. Got the trend that's moving up. We'll see if, the indicators are going to, do right by us. Price is starting to peak above its moving averages. So we'll see if we can get a nice bounce in here. If so, then that's great. If not, then I'll be bailing out like a G. All right. So I was looking at that. I know that those Tesla shorts was coming in real strong last week. And I know Terry and Chris and you guys was eating heavy over here in these Tesla shorts. Real ballsy move, but it paid off. The reward was great. And, haven't shorted Tesla in quite some time. Been a little scary to do that because Tesla is just one of those religious stocks. And so, it had broke out in this little flag here. Boom, had a nice pop up. Bing. When it hit that ceiling there, we've been seeing it sell off. Prices now under its moving averages. And we see momentum drop off. We seeing, things are starting to turn negative towards it. It's still right there at that 50. So, but again, it's likely probably going to fall down to this 100, maybe even down to the 200 once confidence leaves. So once confidence leaves, just like some of those other religions out there, people leave, it just falls apart, So again, it's a confidence game at the end of the day. And then currently right now, we can see the futures market is the S&P 500 is down slightly. NASDAQ is up slightly. So again, I was talking about these consecutive sell-off days that were pretty massive. Normally get a bounce back at some point in time. I'm expecting some type of, bounce back early in the week. And so we'll see how that plays out, because we do have some more economic data that's coming out this week. So I'll cover some of that. Let me actually cover AIZ for Ron. Is that okay? Assurant. All right. So, all right, this is on the radar. Interesting. What I'll do is take the Fibonacci level, swing high to this low, and then we can clearly see we have the moving averages also. Boom. The 200 moving average is a key level of resistance. Okay, we can see that there. And then we also got the 618, which is another level. So if this should break above the 200, then I think we'll get up to the 618 as the next level. And so, yeah, that's an interesting one. It's a little treacherous because it's still trading under those moving averages. Can it break through? It's in a squeeze. So typically, if it's in a squeeze, it should be able to get some power to be able to push through. I don't know if it's going to be a big move just because it's pretty much already at the overbought territory. It's pretty close to overbought territory that we see right there. All right. Okay, cool. Oh, and now that my squeeze finder is pulled up, let's see if we can get some plays over here. BJ's. Let's see. BJ's got a little squeeze in here. Let me just remove that. All right, so BJ's got a little squeeze on there. We'll have to see how that plays out. It's trading above its 50. Again, that's the floor. We can see right here. Boom, boom. You see right here 2 times. All right. And so you're in the squeeze here. We don't have the trend aligning, but we do have a little buy trigger that's right here. So question is, can that squeeze pop it up? I think that's something that's possible. That's worth a trade idea right there for you. What else is on the radar here? AE, it's another squeeze one. But again, the stars are not in alignment. This one here looks pretty interesting. It's got a nice squeeze set up here. Take this swing to that high right there. It does have to get past that 618 that's right above it. But again, that can make some moves for you on that one. All right. And let's just take one more, unless you guys got something on your side. Okay. Materials, I don't know if they're going to really move it. Let's take a look at gold real quick. Okay. Yeah, see, gold is still finicky. We did get a little confidence that came back up. But as you guys can see, these levels I have here, they are so true. They hold true. Gold has just not been able to really clear, except for this one time right here where it came up above, but then it got stopped out at 786 and came back down. But it did try to test this same level again. And so this is a true level here. But now gold is back trading under the moving, the 8 moving average and above the rest of them. But it's chopping sideways. This is a slow mover, so it's more stable and everything. We'll have to see how that's going to play out. Not looking good though. All right, cool. And then CCJ. All right. Okay, so this is an old chart that I had here from that level to this top. Let me actually draw another level here. Bingo. All right, cool. So now I got that level on there. So you can see that. All right, having some issues at this 618. Price came down, but it caught it. So it caught it on the floor right here. You may see some more chopping. It is in a squeeze. Trend is up, it's in a squeeze. And it's trying to come out of this oversold territory. I imagine this is probably going to chop around some more. So if you're looking to do anything on this one, you probably want to put some spreads on it. I wouldn't go in, balls to the walls with the calls. But yeah, I'll, probably throw some spreads on it to take advantage of. I think it's going to probably chop some more. Well, we'll see. All right. And then, okay, one last thing I did want to cover here is the Treasury yields. I know we talked about the mortgage rates here. The 10-year Treasury, everything is tied to this. But just so you guys can see this, what we're looking at with those yields, which I failed to cover earlier, is that we're up at 1.76 on the 10-year. And this is above the previous high in March, which was 1.74. And then you have to go back some more time to really actually understand this. On the range finder here, we'll go back 4 years just so you can get a little more understanding of what's happening here. All right, so this is where we are right now. Geez Louise, let me turn that thing red. All right. All right, so this is where we are right now. And as you can see, we cleared all of that. We're back to when the recession started. We're back at those highs right there. And so that's interesting to see how high will the yields go. So I'll be paying attention to that on a daily basis anyway, checking the bond markets out, seeing that they're going to continue selling. And then if this thing continues to spike higher, that is really not going to be good. So, and that's really going to cause the, again, the economy is going to slow down. It's really going to slow down and likely go into another recession, except for not a recession, but a depression, actually, because there's nothing that the Feds can do once we go into this next recession that they can do to get it out. We're going to have to tough it out. So I hope you got your savings, save. I know it's the new year. You're excited. You want to spend a lot of money. We're definitely hopeful for the best to occur for the year. Hope all you guys have a great, new year. Even myself, I've actually have so many things that's piled up on my plate. I haven't been able to complete the progress that I wanted for Wallstreet Jackboyz itself, but I'm still hopeful that we can get there. So I'm going to intend on continuing to deliver, how we, been doing. But we definitely, want to see some traction on Wallstreet Jackboyz. I want to see, the website and everything pop. So make sure you guys invite somebody. Again, membership is free. If you want the training, then of course you can pay for the training, but sign up. Even in your accounts, you can invite your own friends as well. When you go into your accounts, there is a place. I'll just show you guys real quick. If you go to profile here, oh, look at my profile. If you go to email invites right here, okay, anybody you could just actually click on this right here, and then you can actually just put in their email. And then we have a nice little template that will actually send over. And so the website itself will send the email for you to your friends to bring them over. So definitely invite, as many people as you can, get them over here. We prefer, that you send the invites that they accept and they're truly interested. We only want truly interested people here, not trying to get a bunch of dead weight numbers. We definitely want strong traders, people that can add value to everybody else, so it's a group thing. Also, earlier I was telling you guys about the calendar here. I'll just show you guys real quick. When you go to your news feed on the left side, you'll see this here. What we got coming up this week, we got the CPI numbers that's going to be released on January 12th. We got the real earnings that's going to be released as well. We got the PPI numbers as well. So we got 2 key inflationary numbers that's going to be this week. So we'll have to see how that plays out. But I think the markets may start to stabilize a little bit early in the week until we get to these numbers. And I think that those numbers could be problematic for the progress of the markets. And then we have the U.S. import and export price indexes for December. And then next week we'll have, Martin Luther King Jr. birthday, holiday week, whatever. But anyhow, when you actually go in here, let me just show you the next data set that's coming, CPI. All right. So the way that I designed this, as you guys know, I'll be doing way too much. But anyway, the way I designed this is that you can see what economic indicator is coming out, the event that's coming out. And then you get a nice brief definition of what it is so that you can understand, what the hell is that thing called a consumer price index, right? You see that the most popular measure of price inflation in retail goods and services. Very important economic indicators. I'm letting you know it's very important. Simple. And then when it releases, it tells you the date it releases and the time that it releases, and then also the link. So you guys can click the link. You can take a look at the report yourself. You can post the report. Whatever you want to do is there for you. Also, you can add it to your Google Calendar. All right. So this is a tool for you guys. Make sure you use it. You can add it to your own personal calendar. So, I mean, that's how cool is that? Anyhow, you can also access the calendar from here on the left side as well, where you can see the full view. You want to know everything that's coming down the pipeline? No problem. Click on this and you'll see from the list view, you can see it from this way. All right, everything is coming down. Or you can go to the monthly view. right? You just want a quick overview of what's coming down the pipeline of the month. Bingo. You see everything, what's coming down a month, right? Even next month and the other months, so whatever month's out there. It's all in there for you guys. So again, just another resource for you. Make sure you check that out. With that being said, man, I enjoy being back, with you guys here. And, we'll play it how we play it, man. See y'all in the chat tomorrow. Peace. Good night.